Do you know the only thing that gives me pleasure? It's to see my dividends come in. There's literally not many better feelings than receiving a dividend. It feels like completely free cash, a bonus on top of owning a share, and for that reason, companies that traditionally pay high dividends have always been seen as a safe place to park your hard-earned de-niro.
You talking to me?
Add to this fact that YouTube is literally littered with creators doing monthly dividend passive income reports, and it's really easy to see why as a new investor you can soon become obsessed with picking businesses based on how many dividends they pay. But stop. I'm here today to tell you to stop focusing on dividends when deciding what companies to invest in and provide a more common sense approach to it all. Because I know how it is, you start investing and you see a business that pays a 6% dividend and you get all hot and flustered. Let's get to it. We all want passive income.
I have a question about passive income.
Passive income.
Passive income sources of passive income.
Passive.
And dividends are the sexiest of them all.
I want to move on and talk about something that I'm very interested in, that is dividend products.
You read about the Dividend Aristocrats and see businesses who increase the amount of dividends they pay year on year.
Enforced our confidence in the business by increasing our dividend by 2%.
There's even investing apps offering ready-to-follow pies promising daily dividends. The approach of investing in a business and living off the dividends makes sense. How could anyone argue that getting money from a business by being invested in them can ever be a negative thing? It's free cash, right?
Free cash. Fiver for you. No cash. Well, that was the reaction.
But ask yourself one thing. When in life, has there ever been such a thing as free cash?
Well done, you've just won 500 quid.
In order to realise why a focus on dividends might be flawed, we first need to understand what a dividend is. And I'm not talking about the definition of a dividend, a regular payment made to investors by a company from its profits. I'm talking about what is a dividend to a business before it's a dividend? And the answer is deployable cash flow. All businesses exist to offer a service or product to the world, in the hope that people will buy that product, and once all of the costs of producing and selling that product are taken away, the business is left with cash. Cold, hard, can't live without it, cash. At that point, the business has a choice. What do we do with this money? Do we reinvest it into new ideas, product development, or maybe buy out a competitor? Or do we use this cash to reward those who have invested in us, either through share buybacks or everyone's favourite, a dividend? To the business, it's just cash, deployable cash. And that deployable cash represents an option for that business. Basically, the business needs to make a choice on where it's going to put that cash in order to help itself make more cash. So it needs to weigh up all of the options to see which has the most benefit to shareholders. At the end of the day, if you take £1 billion worth of profit and reinvest it into the business and that can help you secure tens of billions in the future, it doesn't make sense to give that money away as a dividend. Instead, you should be reinvesting it into the business to generate that extra value. The issue is, dividends feel great. It's something called the mental accounting bias, or the bird in the hand theory. The saying goes, a bird in the hand is worth more than two in the bush. So something you can hold is worth more of that thing that's out of your control. But what if you're trying to make more birds? Unless you're going to do some pretty messed up things to this little guy in your hand right here, surely the birds in the bush are your best chance at making more birds or making more value. It takes two, baby. There is a school of thought called the Dividend Irrelevance debate that argues dividends are in fact pointless and provide no real value to an investor. Now this is as hot a debate as would you rather fight a horse-sized duck or 100 duck-sized horses. And while I won't go into all of the points of the debate or how terrifying the idea of fighting 100 duck-sized horses is, essentially at the point a business gives you a dividend, that business drops in value by the exact same amount the business has handed over. That makes sense really, because think of it this way. The money isn't free. The business is literally giving it away to you. It won't generate more income. The value that money had is gone. So the business's real, or book value as it's called, has dropped by the same amount as they have given away. Now the counter argument to this is in reality the stock market doesn't price on book value very well. And in the short term the price of a share is actually driven more by human emotion, as we discussed in last week's video. So you might not see an obvious £1 drop for a £1 dividend. But the point still stands. The business has taken a bird out of the bush and put it in your hand. And while you're sat there going, oh, this is nice, a bird.
Pretty bird. Yeah, can you say pretty bird?
Is that actually the best thing for the growth of the business and your portfolio in the long run? Most businesses follow a life cycle, just like a human being. They are born, they grow, and eventually one day they will die. At different stages of a business life cycle, it makes sense for a business to do different things with the cash that they bring in. Imagine a brand new business that might not even be profitable. It makes absolutely no sense for them to be paying a dividend. It could literally kill the business. Does that mean it's a bad investment? Hell no. In the same way, when a business is rapidly growing and expanding, it needs to be investing the profits in order to fuel that growth. What do you want? A 5% dividend or Amazon, Google levels of growth that come from aggressively reinvesting profits? Only once a business matures and enters the stage where it can't really see much value in prioritising growth does it really make sense for them to start taking profit and paying out dividends. Alphabet, the parent company of Google, doesn't pay a dividend, so they can fund growth. Seems to work for them. Interestingly, Alphabet do something called share buybacks. This is where they buy back some of their own shares and then get rid of them, making the remaining shares more valuable because there's now less of them. £1 billion in share buybacks or £1 billion in dividends provides the same level of value to us as investors, £1 billion. But for some reason, the market does not react badly if a company doesn't do a share buyback. They do react badly if they stop paying a dividend. So Alphabet or Google probably recognise this and use buybacks to reward investors instead of dividends. Another thing that I don't really see widely discussed anywhere else is we all have this understanding that anything that you do inside of an ISA is tax-free. But that isn't actually the case. So share buybacks, which increase the value of the share or the share price growing over time, that is tax-free if it's inside of an ISA. But if you invest in American companies, the Fed, which is their version of the tax man, deduct at least a 15% tax of any dividend payments you get before they hit your ISA. So on a pure tax basis alone, share buybacks and growth in the value of the stock is more efficient than dividends because of that 15% tax. That's only American shares. It doesn't apply to the UK, but let's face it, most of us are buying American businesses. There's another point. Once you start paying a dividend, you can't really stop. That means in reality, the fact a business pays a bigger dividend every year could actually be stopping them from innovating and investing in themselves. It only makes sense to pay a dividend if the other options of growing the business are not as fruitful. That's the on-paper smart thinking, but it doesn't work like that because of the irrational way the market reacts. So if a company stops paying a dividend, you can bet that that share price is going to drop because people see it as, I was getting £10 yesterday, now I'm getting nothing, this company is bad. But what if in reality the company's just discovered the next sliced bread and they need to stop paying that dividend so that they can invest in slicing some bread and making you loads of dough? For this reason, if you're looking at investing in a business due to their dividends, you need to be looking at how sustainable that dividend is. You can do this by checking something called the dividend payout ratio. This is how much of the company's profits are paid out in a dividend every year. So if I had £100 in profit and I give £50 of it away in dividends, I would have a dividend payout ratio of 50%. Anything below 50-55% is considered sustainable because there's enough there for them to go away and invest in other projects while still maintaining that dividend. Some businesses honestly have dividend payout ratios as high as 90%. There's even been cases of businesses where they've had to borrow money to sustain the dividend. Moody. How do you check this? Easy. Just Google it. Just type company X dividend payout ratio. Whoop, there it is. Interestingly, in the song X produced by Dr. Dre, there's actually a line that goes, going up and down on my dick like the stock exchange. It's nice to see that Alvin is aware of the short-term fluctuations in the stock market. Yes, that's right, his name is Alvin. In summary guys, here's what I think for myself, because at the end of the day, this is all just opinion. But dividends are not the be-all and end-all, and a strategy that focuses specifically on companies that pay high dividends could lead to less growth in the future. You would actually be eliminating about 30% of the companies on the stock market that don't pay dividends, and that would be eliminating companies like Google. People may quote that Warren Buffett has a large focus on dividend stocks like Coca-Cola. But don't forget he bought them in 1988. He didn't buy Coca-Cola because of the dividend, he bought them because they had a lot of potential to grow. He now sits back and enjoys that dividend because of the growth. But that doesn't mean I hate dividends. I have companies in my portfolio that do pay dividends, but I haven't bought them because of the dividend payment. I have bought them because I think they've got good growth potential going forwards. The only thing I do with my dividends is reinvest them back into my portfolio to benefit from the compounding effect. That's why you'll never see a dividend income report on this channel, because I think it just sends the wrong message. At the age of 30, approximately, I think the focus should be on businesses that grow, not businesses that pay an ever-increasing sustainable dividend. Coca-Cola is never going to do for your portfolio what something like Tesla has done for a lot of people in the last couple of years. I want to be taking a stab at that action while I can. Maybe when I'm 50, 60, I'll care a lot more about dividend paying stocks because I want a stable place to park my cash that produces a regular income that I can live off. But for now, I got as many birds in that bush as I can getting down and dirty. Don't worry RSPB, nothing dodgy going on here, all the birds consented.
Polly want a cracker?
Whoa, clear out the room, I'm coming through, they wanna see what I'm about. Yeah, I got skills, do it for the thrill, I'm on a paper route.